Hello, this is Mr. Smith, and this is Honors Economics. This is the daily participation. Please click on Resubmit, and a text box will open up, and you can type 3 significant items from today's lesson. So today we'll look at the Federal Open Market Committee and other tools that can be used in order to influence the economy. The FOMC, the Federal Open Market Committee, is probably one of the more powerful entities within the Federal Reserve and economically speaking in the world. They control the open market operations, which is one of the 3 tools that can be used to influence the economy amongst the Federal Reserve. Open market operations are when a centralized bank like the Federal Reserve either buys or sells securities, bonds, in the open market as a way to change monetary supply. And what is this used for? The Feds want to, of course, promote stable prices. They don't want inflation to occur, so they will contract the economy whenever they think it's heating up too much. And they also want, of course, the economy to perform well. And they certainly don't want deflation. And so they can increase the money supply in order to make sure that happens. So in order to do either of these things, they require opposite steps to be taken. They can either have a monetary policy or a contractionary policy. So looking at a monetary policy, it's basically, as it says in the graphic there, it's like tapping the accelerator. You want to put your foot on the gas and press it. So the committee wants interest rates to decrease because with decreased interest rates, more borrowing and more spending will occur. When there's more spending, more purchasing happens. And when more purchasing happens, more people are needed to work in order to make those goods or services. So the trading desk is directed to engage in open market operations, including the purchase of government securities. So when they buy bonds from banks, they're purchasing the bonds, they're taking the bonds from the bank and giving them cash. And with more cash on hand, the banks can then turn around and expand their own loaning out to people to buy cars and houses and for businesses to expand or buy property or capital, such as tools. So this injects reserves into the banking system, and this puts downward pressure on the federal funds rate and other interest rates, basically lowering the rates and therefore encouraging more borrowing. So there's not only more money available, lower interest rates encourage people to go out and get loans and spend. Then there's the opposite of it. The contractionary policy is like putting your foot on the brake instead and trying to not necessarily stop the economy, but slow it down some because it's moving too fast, expanding too fast. People are making too many risky investments, too many loans that are risky, and it could cause a bubble that could burst. And on top of that, it's also causing the dollar to move at a higher velocity. There's too much demand going on, and so it's causing inflation. And because of that, you might need to cool the economy down some. So the Federal Open Market Committee wants interest rates to increase, and they want to remove money from the system. So the trading desk is directed to engage in open market operations, and this time they will sell bonds. And these bonds are attractive because they're stable, they're from the government. You get your money back with interest eventually, and so banks are eager to buy them, and when they buy them, they, of course, turn over some of their money. They're purchasing the bonds, they get the bonds, and they're giving the money to the Federal Reserve. So banks have fewer reserves available to lend and also puts upward pressure on the federal funds rate and other interest rates, of course, which means that people are going to be less encouraging when it comes to getting loans to purchase things, and so less purchasing will happen and so on. Of course, one of the difficulties of this and one of the criticisms of the Federal Reserve is obviously you can do either of these things too much in one direction. You can overheat the economy with expanding it, or you can contract it too much, causing a recession with the opposite action. But the FOMC and the open market operations aren't the only tools that they have. They can also change a few other things. For instance, the reserve requirement. This is the amount of money that banks are required to keep in their vaults to cover when people to come in and either close their accounts or make withdrawals. They need at least a certain amount of cash to cover a probable number of people and volume of money that will be withdrawn in the short term. And so when they raise the reserve requirement, they're asking for banks to keep in more money, which means they can loan out less money, which means people will make less purchases and fewer people will have jobs. So raising the reserve requirement is part of the contractionary policy. If they decrease the reserve requirement, it's going to cause an expansion in the economy. Because if you lower the amount of cash they have to keep in their vaults, they're going to loan out more, and then people are going to borrow more, people are going to purchase more, and more people will have jobs. Then there's the discount loan to banks. And this may also be referred to as the discount window. And basically, banks loan to each other. And the Federal Reserve also loans to these banks, since it is in fact also made up of banks. And what happens is that lending to member banks, what they want to do is they want to affect their bank reserves. And the purpose is to change the federal funds rate. This is the rate that banks charge each other for very short-term loans. And so if they want to contract the economy, they want the rate to go up, because if they're having to pay more for the federal funds rate for borrowing, then they're going to have less money to loan out to people, and less money for people to borrow, and less money for people to purchase, and there'll be fewer jobs. If they want to expand the economy, then they want to decrease the federal funds rate or the discount window, and so then banks will have to pay less to borrow, more cash on hand, they can loan out more to people, people can borrow more, people can purchase more, and more people will have jobs. So the discount loan to banks, reserve requirement, and open market operations are traditionally the tools that are used to influence monetary policy and the economy. Another one that's come up more recently over the last decade is quantitative easing, or QE. And it refers to the policy in which a central bank purchases a pre-evaluated amount of government bonds and other such financial assets for the purpose of directly injecting liquidity and cash into the economy. Hence, it is also termed as large-scale asset purchases. So what does that mean about what I just said involving quantitative easing? Is basically it's the same thing as open market operations, except open market operations usually just involve short-term assets, short-term notes that or bonds that are only for a smaller period of time. What the quantitative easing could do is it could actually purchase different types of assets. It could purchase long-term bonds that are good for a decade, which they don't always want to do, because that involves playing with a marketplace object that is obviously stretched out over the long run. You want to make short-run changes. That's what Keynesian economics is based on. On the short run, you want to make changes to either expand or contract the economy. They might also want to buy other things like mortgage-backed securities, which are bonds basically, or pools of debt involving things like real estate purchases, for instance. And this is what happened during the 2008-2009 financial crisis. And they go and purchase these mortgage-backed securities because at that time there was the housing market crisis. Too many loans are being made. Companies and banks are failing that were invested in these bad mortgages. And so the government had to step in, because otherwise it would create a ripple effect and destroy huge parts of the financial sector, which would involve other people's money. And the FDIC and the Federal Reserve couldn't necessarily cover everything if all of it failed. And so they chose to target specifically mortgage-backed securities. And they got involved in that one particular part of the economy. Now, that's controversial, because if they target specific parts of the economy, are they playing favorites? They say, no, we're only going after the data. We're only tackling the problems that occur as they come up, and it's only during bad economic times. Otherwise, if it's for a smaller part of the economy or just one business or whatever, obviously there have to be consequences. Businesses and people must fail in order to learn their lesson. That's how capitalism works. We strive to become better, more efficient, leaner, more competitive, etc. But if it's an entire industry, then obviously they need to become more invested. And so that's one reason why it's controversial, because they get involved with something specific, or they get involved with something specific over the long run, like those long-term treasuries, for instance. And another reason why it's controversial is because in both cases of open market operations and quantitative easing, the Fed is purchasing assets. They're purchasing bonds, treasury notes, mortgage-backed securities, whatever. That money is created by the Federal Reserve. Basically, it's strokes on a keyboard, and they create a certain amount of money digitally, and that is used to purchase it. Now, you might wonder, isn't that bad when the government creates money? Well, remember, it has to change the money supply, even just naturally, because there's an increasing number of people, for instance. So that number can't be frozen. We can't have the same amount of money produced in 56 as we have now. That just wouldn't make any sense. And so producing it in shorter spurts over the short run like that isn't going to be harmful, but it's important for them to keep a tight money supply. Would it be harmful if they used quantitative easing or open market operations or any of those other methods to expand the economy when there's already the economy is doing well and unemployment is low? No, that's going to cause inflation. So obviously there are times they shouldn't do it, and they can't necessarily do it over an extended period of time, especially like a decade or something like that. That'd be ridiculous. But in the Great Recession, in particular in 2008, 2009, they had already lowered other rates to zero or close to zero. And so they couldn't go any lower. And so they needed to tackle other parts of the economy that weren't doing that well and that were dragging everything else down with it. And that included the housing market. So that's why they did that with quantitative easing. Now, some people say, well, this is proof of why the Federal Reserve shouldn't exist, or how it's playing with funny money and is just creating money out of thin air. But remember, the same is true even if you use the gold standard. If we wanted to go back to a decentralized currency system where each state had its own paper currency and each of them used some kind of gold or silver standard or whatever, the problem is, first of all, now you have, how do you know each of these 50 states are doing the right thing and creating their money? Second of all, how do you know that they are actually basing all of them equally, as printing a certain amount of dollar bills or notes based on a certain amount of gold or silver? And the thing is that their state government can just change its mind. They can say, well, we're going to produce $100 for every gold piece that is so many ounces. But then maybe the next day they say we're going to raise that to 1,000. So that can be a problem, especially if they aren't following the marketplace of exchanges in the first place for money. And the same is true of cyber currency. It's true that they don't have a controller, that they're independent, that they are only being controlled by the marketplace. How valuable is a Bitcoin? What is the supply and demand? That will determine the value of the Bitcoin. The problem is, of course, is that's a little bit misleading because obviously someone created the currency in the first place. Like Bitcoin was created anonymously by just one name is given, but it's probably a group of people. And the question is, do they actually have some control they're not letting everybody know about? And with any type of technology, it is kept track of on a worldwide basis on a number of different computers and all kinds of other things. So no one ever says it's impossible to manipulate it. They say it's unlikely. And that's the thing about technology. There'll always be somebody else that can come about and get involved and tackle a particular currency. That's always possible. But luckily with the dollar system, even though it's often said it's controlled by the Federal Reserve and that's a big, powerful organization, it really is decentralized as well because each bank participates in the money supply, even a small local bank that only has one branch, for instance. So that is why when people talk about the craziness of the Federal Reserve, that's just because they're uncomfortable. It's a big decision being made with lots of math behind it. It's made by people who have a lot to lose, the banking industry. But remember, that's also our money, so we also have a lot to lose. So their interest or our interest. And the people look past the fact that it really wouldn't be any different. In fact, it'd even be more chaotic if we had just an open, free system of currency, which is what cyber currency advocates really want. There would be too many variables, too much confusion, too much inefficiency, too many different systems. And the same thing is true as if each of the states had a decentralized system to use their own as well. So yes, there is some uncomfortability, but education, understanding, making sure there's information, the Federal Reserve coming and talking to Congress every once in a while to talk about these decisions, that all can help prevent that misinformation and fear from happening, which is unjustified.